Ethereum is going through an interesting transition period. It used to be the leading smart contract platform, but now it seems to become victim to its own success. There are now the layer 2 scaling solutions, Base being the major one, but there's also Arbitrum, there's also Optimism, and that changes the dynamics of the Ethereum mainnet as well. Let's have a look at the on-chain data, the data most people aren't considering. Let's try to figure out where Ethereum might be going from here. And let's start with a statistic most people do not have on their radar anymore. And the reason why we stay with this data is because I want to show how important it is to still stay skeptical, even when we've got something that's verified information. Here is something very few people still pay attention to. This is the number of weekly traders of Ethereum NFTs. Nobody is talking about NFTs anymore, but it seems like the number of weekly traders is pretty stable in the last 1.5 years. The reason why I want to show this data is because a lot of the activity on chain can just be automatically generated via trading bots. And I believe that's what's going on with the NFT market as well. Many of the transactions that are generated through those traders are not done by humans. Have a look at the weekly trading volume in the NFT market. This now shows a much more realistic picture. Sometimes there's a bit of a tension, then it comes crashing down, then we see a revival, but in general the market is very small compared to 2 years ago. But let's have a look at the drivers of demand and supply for Ethereum itself. Ethereum is now a proof of stake blockchain, so Ethereum can be stacked away to get some return, and that supply isn't circulating anymore, which is good in theory for the price development, right? Less supply with a steady demand should lead to increasing prices. Now the number of ETH that's getting staked is increasing over time. Now the Ethereum supply is increasing as well, so it's probably better to look at the staked ETH as a fraction of all of ETH. And that's at an all-time high. 31% of all Ethereum is currently staked. 1 year ago, that was only 29%. So it seems like at a rate of roughly 2% per annum, Ethereum is taken away from the circulating supply. That is a relevant number. When we look at all of the supply that's held by the exchange trader funds, by the ETFs, that amounts to 5.4%. Now let's look at the staking in a bit more detail. Isn't it interesting how Lido is losing market share, relatively speaking? The trend seems quite constant, and of course it does have impact on the LDO price as well. Have a look at this. This is LDO relative to Ethereum. It peaked 2.5 years ago, February 2023, and since then underperformed the Ethereum price by 88%. And the trend seems to be continuing. Lido continues to lose market share. But this is a video about Ethereum, not about Lido, and about the changes that happened within the Ethereum ecosystem. There were a lot of complaints that the Ethereum mainnet is too expensive to transact with. During the NFT bubble, a single transaction could cost hundreds of dollars. And because of that, layer 2 solutions on top of Ethereum got promoted and pushed a lot. That led to the Ethereum gas fees plummeting. After the adoption of the layer 2s and after the move from proof of work to proof of stake, Ethereum became a blockchain that we can actually use, that's not prohibitively expensive to transact in. By the way, if you so far enjoy this content and you don't want to miss future videos, then feel free to subscribe. I publish videos regularly over here. Just have a look at the individual data. This is the number of transactions on Arbitrum, so one of the layer 2s on top of ETH. Here's the number of active addresses on Arbitrum. Here is Optimism, number of transactions. Here's Optimism, number of active addresses. And here we've got the base chain, the largest of the layer 2s. Number of transactions versus number of active addresses. The project of moving activity away from the main network to the layer 2s has been very successful. Have a look at the number of unique transactions of the layer 2s relative to the Ethereum mainnet. The mainnet is now processing less than 10% of the transactions. And there's really one major driver that accelerated the transition to the layer 2s, and that's Coinbase with its base chain. Yes, without the base chain, we also saw adoption of the layer 2s, but once we include Base, the chart looks very different, right? This is all Coinbase taking over the entire ecosystem. Have a look at the Coinbase number of transactions over time as a share of all layer 2s. That's this light blue area on this chart. Now, on the one hand, this all seems great. Everything is going according to plan. The mainnet is not clocked anymore, and people can have very cheap transactions on the layer 2s. But there is also a caveat to all of this. There is a secondary effect that's not that great for Ethereum holders. Because while it's now very cheap to transact, this is the median gas prices on the Ethereum chain, it moved to close to nothing, and again, used to be in the hundreds of dollars. That also means that the tokenomics, or the supply situation of Ethereum, has worsened. Because with every transaction that happens on the Ethereum mainnet, we see Ethereum getting burned, getting taken out of circulation. We've got new Ethereum that enters the market through the staking incentives, but we've also got Ethereum that gets burned through usage. If the usage of Ethereum, of the mainnet, isn't high enough, then Ethereum is inflationary again. Then the supply expands. And that was the big selling point of Ethereum with the merge. When we moved from proof of work to proof of stake, Ethereum turned into ultra sound money. So sound money being money that has a stable supply, ultra sound money being money that has a shrinking supply. And that plan in the beginning seemed to play out properly, as in there was a reduction in Ethereum's supply. More Ethereum got burned through its usage, then got issued through the staking. But then, as more and more transactions moved to the layer 2s, Ethereum is now becoming inflationary again. It's currently almost as inflationary as Bitcoin. It's got a very similar supply expansion of 0.8% per annum. Really, when we look at the underlying growth of the Ethereum network, it is very slow, but it is steady. We do see new people coming into the space, and some of those people stick around. But the growth is slower than most people might expect. This is the number of active addresses on Ethereum split up by new addresses versus returning addresses. So the growth is not accelerating, as in the number of new addresses is relatively stable. It's between 500k to 1 million per week. The number of returning addresses is growing though. So there is some stickiness to the Ethereum network. Not everybody that enters stays around, but some do. And that's why we see long-term growth in the number of active Ethereum addresses. But again, if you just look at the number of returning addresses, this may be doubled over the last 7 years. Ethereum's price, of course, increased much more than that. So it's not just the usage of Ethereum that's pushing up the price. It's also the adoption of Ethereum as an investment vehicle. For example, the purchases of Ethereum through the ETFs. This is the number of ETH that's held through the exchange traded funds. Initially, the ETFs had very poor adoption, but then came the story of the ETH treasury companies, spearheaded by Tom Lee's BitMine. But now that excitement is slowing down, as in the last 2 to 3 months, there is barely any growth. The question is, how will this continue? Because we don't have enough sample size yet, right? This is only 15 months of data. Compare this with the Bitcoin ETF data. This starts already in January of 2024. So that's almost 2 years of data. And here the purchases seem to be much more constant. Here's the number of active traders on Ethereum over time. So while the number of active addresses is growing, the number of traders is not necessarily growing. Here is the trading volume, very similar picture. Again, just because we have more active addresses doesn't mean that the trading activity goes up as well. The main driver for Ethereum is the narrative around real-world assets, around tokenizations of assets. And of course, stablecoins are currently at the top of that. In the early days, it used to be tokenized assets or bridging of assets. This is the number of tokenized Bitcoin on the Ethereum blockchain. It peaked in April of 2022 and since then has stabilized. But compare this with the Ethereum stablecoin market cap. This still has very nice growth. Growth of roughly 60% per annum, at least if the last 12 months are representative of future growth. The decline over here started when Terra Luna went bust, so the Anchor protocol, the UST stablecoin, imploded. And then since October of 2023, we see growth again. Stablecoins are really the main driver of the Ethereum network now, much more than decentralized finance. Because again, the total value locked, or the capital that's in decentralized finance applications for Ethereum, is not seeing an all-time high. It's just at similar levels to the peak of DeFi summer. And we don't know if we will grow beyond that peak at the end of 2021. But we've already grown way beyond that in the stablecoin market cap. What I find fascinating is that the development within the altcoin market seems to move contrary to what's happening in Bitcoin. So in Bitcoin tends to do better, then the altcoins are rather weak. When the altcoins tend to do better, then Bitcoin tends to be weak. What we're seeing over here, that's the others dominance. So how much of all of crypto is in the altcoins that are not in the top 10 in terms of market cap? So it's a percent range that tends to peak out at around 20%. It's currently at 7%. Now have a look at the following. Let's have a look at the peaks and the bottoms. Let's also see where there's a potential support. That's maybe here. And let's now compare this with the Bitcoin dominance. So how much of all of crypto is currently in Bitcoin? Whenever the others dominance is peaking, the Bitcoin dominance tends to be low. Whenever the others dominance is bottoming, the Bitcoin dominance tends to be high. Here's another such peak where the Bitcoin dominance is high and the others dominance is low. So there seems to be a direct inverse correlation. And since the beginning of 2022, the altcoins tend to underperform and Bitcoin tends to outperform. And Bitcoin tends to trade in a range. It tends to peak at a dominance of 73%. So once Bitcoin is 73% of all of crypto, the altcoins historically were very cheap. The problem for altcoins right now is that the others dominance still continues to go down and Bitcoin dominance still tends to go up. And while the others dominance didn't necessarily always bottom at the exact same level, it tended to be somewhere around 5 to 6%. And currently we are at 7% dominance. And again, Bitcoin dominance has way more room to go until the altcoins become historically cheap again. So really, it does make sense to be selective when purchasing alts. It's maybe not the best time to have a diversified altcoin portfolio because most of them are likely going to be worse medium-term performers. What we see over here is the others market cap. So how much capital is currently in the altcoins that are not in the top 10? We're not looking at the others dominance, but at the others market cap. And the altcoins do have a hard time getting above 500 billion market cap in aggregate. Here's a similar metric. This is total 3 ES. So that's all the altcoins that are not Bitcoin and Ethereum, and we also exclude the stablecoin. This metric has a hard time going above 1 trillion. There is a fundamental problem though with all of those metrics. So with the others dominance, with the others market cap, with the total 3 ES market cap. And the problem is that market caps are not a good indication of where prices are going. And prices in the end determine our performance as an investor. Let me show you what I mean. Here as a representative example, we've got WorldCoin. WorldCoin tends to peak at higher highs in its market cap over the very long term. Yes, we've got our volatility. Currently we tend to dip a little bit, but in general, over time, the market cap is going up. Now compare this with the long-term price chart. That's very different, right? It's not going up from peak to peak. The peaks are lower over time. And the reason for that is token inflation. It's the number of WLD or WorldCoin tokens that get issued over time. The supply grew by 8x over the span of a bit over 2 years. That's of course very extreme, but in general, we tend to see most altcoins expanding their supply quicker than Bitcoin or Ethereum or Solana over time. The effect is very drastic. So every week we see more than 1 billion worth of unlocks in the altcoin market. And that's just for the altcoins that are tracked here on this website, Tokenomics.ai. And so I believe this is where the market inefficiency is, where we can actually exploit that inefficiency and make money. Because it seems to be obvious that something like WorldCoin should go down in price over time. It might not go down in market cap, but it will go down in price if the supply expands this way. Yet the vast majority of traders does not agree. Have a look at this. This is the perpetual futures funding rate. So with perpetual futures, we are betting on a price. We are not buying the asset, we are betting on the price to go in either direction, to the long side, so it goes up, or to the short side, it goes down. And because the funding rate is positive most of the time, most traders on the perpetual futures market are betting on WorldCoin going up long term. They're also betting on it going up right now. Again, despite the supply expansion, despite what history has already told us. Isn't that interesting? Most perp traders got wrecked because of the token inflation. Or in other words, the token inflation is not properly priced into the funding rate. So really, the game should not necessarily be to try to find the next small altcoin that does another 10 or 100x. Here's the performance of the smaller altcoins in the last year. Most of them went down. Yes, the larger altcoins did better. So here's the performance of the top 100, but still, even they, in aggregate, went up only by 43% in the last year. While at the same time, Bitcoin went up by 71%. Ethereum went up by 69%. So even the biggest of the altcoins aren't doing great. The smaller altcoins do even worse. Have a look at this. This is hyperliquid. This is the funding rate of WorldCoin right now. It's 11%. The longs have to pay the shorts 11% per annum to bet on rising prices. In other words, when we bet on falling prices of something like WorldCoin, we are even getting paid 11% per annum. And then we are making money on top of that because of the long-term underperformance. This is the WorldCoin price relative to Bitcoin over the long term. It went down by more than 90%. But now imagine we are flipping this around. We are betting on falling prices of highly inflating altcoins. At the same time, we bet on rising prices of Bitcoin, Ethereum or Solana. So instead of having this relative performance, we are getting this relative performance. Isn't that much more attractive than even just buying Bitcoin itself? This is a performance of 900%. Bitcoin during the same time period made a performance of 289%. So there's clearly alpha in a strategy like this. There's also volatility, like we see over here, but this is a quote-unquote buying opportunity, right? We double down on being even more long Bitcoin and even more short WorldCoin. If you, of course, believe that long-term the tokenomics will prevail, which they have over years. And again, this is just an example. Many altcoins work like this. The overall altcoin market sees massive unlocks every single week. And the reason why those unlocks exist is because the venture capitalists, they want to pull out their capital. The team wants to pull out capital. The insiders, the KOLs, etc., they want to pull out the capital. They are all dumping on the retail investor, and they are dumping at a very quick rate. That is very harmful for the altcoin market. That's why we see this performance across the board. I'm following this kind of strategy already for 4 years. In the early days, it was with borrowing and lending platforms like Aave. Nowadays, it's with perpetual futures. And this is my long-term performance here. So this is a monthly chart. It shows the last 4 years. Had I just dollar cost average into Bitcoin, I would have gotten this return here at this light gray line. But because I also bet on falling altcoins over time, I got long-term outperformance. And this is really what crypto should all be about. It's about the constant alpha. It's not about finding the 1 or 2 lucky moonshots. We want to simply compound our capital reliably over time. I have made many videos on the topic, but you don't have to watch all of those videos. You can simply stick with 3 of them. The first one is over here, using perpetual futures to bet on relative valuations. Then this one over here, risk management with relative valuation bets. Very important. People that didn't have this in place, they got wrecked in the recent crypto shakeout, which was, by the way, one of our most profitable days. Everybody has lost their money, but we had our risk management properly in place. And one part of that risk management is, of course, also setting effective stop losses. So that's video number 3. In total, all 3 of those videos combined is roughly 1 hour of content. Once you've watched that content and you've joined the community, I will share my favorite trade with you. If you do not make money with that trade after opening it and after holding it for 1 month, then I'll refund the premium membership fees to you. So really, you are not risking risking those 125 US dollars per month. If you do not like premium, if you do not make money with that trade that I will send you after joining, then I will just send that money back, no questions asked. A link to premium will pop up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.